Everyone's New Year's resolutions go to die. This is what happens when people have made all these astounding life changes that they would like to have. I want to do this, I want to do that. Yeah, this is where people now start saying, yeah, maybe realistically. This is where the word realistically starts kicking in, and they start to realize maybe I wasn't meant for this. People start to now understand that, okay, maybe they need to take things
Mm.
incrementally. Maybe that goal to do things, and obviously a lot of willpower also drops off. A lot of people unfortunately realize that they're not as strong as they thought they were. And that's the unfortunate part, I think, of this week. But I pray as many of us do not do that. All of us who are involved in the 52-week money challenge, I hope people will still continue to push through and persevere. That's my biggest ambition for people. Don't give up. Don't let go. So let's get into some of the data, Vernon, for this week. In terms of markets, and we continue to see a steady decline in our kwacha, and officially now we're now, well, let me not say officially, but probably as of today, we will now be at pre-election levels of the Zambian kwacha, if the central bank measures have not kicked in and changed things already. So that's what we're going to really have to pay attention to. Will the central bank measures of trying to control the exchange rate through the reserve ratio, will that actually have kicked in and had any positive effect? Because today is that kick in day when the central bank will now be measuring banks and looking at how much they have in terms of kwacha in their reserve. Remember, raising the reserve ratio from 9.5% to 11.5%. Therefore, that should actually try and pull some money off of the market, and obviously make it also difficult for people to try and borrow to try and bet against the currency. That's the main ones they probably want to take care of. Those who are speculating against the currency for gain or for profit, and unfortunately, that tends to happen. I can borrow money overnight, buy dollars in the morning, and then sell them by the end of the day to make a spread higher than what I would have paid in terms of interest. So this is what we're trying to. This is what obviously this is what is trying to be combated. And this is what is trying to be stopped. But we'll see whether we actually have an opportunity to deal with that. Now, let's take a look at obviously data in terms of that. We saw the continuous slide. We're now at 19.30 pre-election levels of the Zambian kwacha. Pre-election levels of the Zambian kwacha were around 1934. That was the final pre-election levels of the Zambian kwacha that we were actually looking at. So we're just very close to that
Okay.
pre-election Zambian kwacha buy up. Remember that when we had that, what we termed, as I said, with the Bali rally, as we liked to call it then. Now we're seeing the rand obviously get also weak a bit. Remember, after the State of the Nation address in South Africa, you saw 1.0. We saw the rand drop down to 1.0798, down 1.28%. Obviously, the electricity woes of South Africa are frightening a lot of the investor class, and also we're also getting a little bit of a shake from the global economy. We're getting a little bit of shake from the global economy altogether. So we should try and see what we can do. What we can do to also try and take try and see if we can get some sort of benefit out of the weaker rand, because this is the time obviously to start to see if you can take a little bit of advantage of it, because the trends are pushing upwards against our currency. So we do have a weak kwacha, but remember, this is also being supplemented by a weak rand. Now, for all who are looking into the bond markets, also bear in mind this week is bond investment week. There is an auction coming at the end of the week, and it is due in the final. There is a bond auction that is due in the final on Thursday. That's when the bids are coming in on Thursday. So we will actually see if there are any changes to the market. But for now, it still looks like we have no apparent changes to how the market is going to be doing in terms of bonds. So we do see that we did see a treasury bill auction that did also push interest rates up. So there is a little bit of an upwards pressure in the short term. So the likelihood that we're going to see interest rates come down is probably unforeseen. But always prepare yourself. I always give people who I'm obviously overseeing advice. I always tell them, always prepare yourself with a lower bid. The good thing about our auction market is that even if you come in with a lower price bid, you'll still be accepted at the same price because we use a single price. Our auctions are what we call single priced auctions. So, in other words, whatever the cutoff price is, everybody gets. So, it's always a safe bet to try and come in a little bit lower, just to be on the safe side in case that's one of those downturns where you end up getting caught on the wrong side of things. Other parts of the global economy that we are starting to look at, we did see oil continue its mid slide down. So oil has started. Oil has continued that it did get up to 85 mainly because of Russia. Russia did say that it is going to try. Russia did say that in terms of oil, it is going to try and push its output downwards. Russia is not keen on trying to put too much on the market in retaliation for a lot of the tariffs. So that is what's been the main driver, trying to push the Russian state to do that. But unfortunately, for us, but unfortunately for global oil traders, that does mean that oil prices were starting to come up. Unfortunately for us, let me rather say. But however, the weakness and the fragility of the global economy has kept oil at 85.59. So we are seeing that there is heightened price pressure on oil, but that also means that there is a little bit of struggle in terms of which direction it is going because it's not pushing as high as it should be. So oil is up to 85.59. But remember that this is a battle versus Russian undersupply versus global oversupply. American barrels are increasing in supply. So you do have an oversupply, but you have a strategic undersupply when it comes to Russia. So Zambian, should we be banking on the fact that oil might be getting cheaper? No, that is not a smart way to try and play the market for us. So let's just try and leave this as to oil is probably going to get a bit higher. Now, conversations came in from our energy minister who's now starting to talk about oil blending because I don't know when they went very quiet on that. Remember that we're talking about mixing oil with 10 to 20% mix of local ethanol. That was part of what was supposed to happen. Local ethanol was supposed to be mixed into oil. That should have been affecting the oil price. But we will see. I mean, the DAP said that the project has kicked off. Now, remember, my view on local blending is this, Vernon. I view it as an opportunity more for job creation than I view it specifically for oil price reduction. Now, it probably will have an effect, but remember, the problem with it is 80% of this price is being brought by geopolitics, it's transportation. And he's also still trying to say, look, we're still trying to push to clean that Tazama pipeline because the problem that we're facing has got to do with transporting oil. Now, even I saw that when we're looking at the recent price, the logistics price of oil and the cost and whatever other processing prices were really the major factors that were bringing the cost up. Now, obviously, oil transporters have then gone in and screaming and shouting and saying, "Oh, but what about us? Will our jobs be gone?" And there we go. Somehow, the government has to be Santa Claus. There's no trade-offs with voters. My biggest problem, Vernon, when it comes to us as citizens, is that we don't understand trade-offs. We want everything, and what that reminds me of. That reminds me of a child screaming in a corridor of a store. That's what it reminds me of, where a child wants absolutely everything. Mommy, give me this. Mommy, give me that. Mommy, give me that. That is what we're starting to sound like. But anyway, it's mostly because most of our rhetoric is driven by politics and not driven by logic and reasoning half the time. It's this political party has said, what about this? And then the people in our government are then saying, no, but then we are responding, and then this, and then that, and then this, and nothing ever gets done. Because people are having these what they think are healthy debates for society, but really they're just wasting a lot of people's time. Look, we have to make a decision here. What's more important, inflation or our job market? It seems our job market is obviously important, but inflation is. We have to find a way to balance it because the decision has to be made. People, it's not about people's feelings anymore. A decision just has to be made, and an action has to be taken, and we have to go in that guideline. So I don't see a future even for most of this conversation. To be honest, I just think everyone just needs to calm down and give it a break. Now, I will say I am now in terms of policy wise, it is important, like I said, to start looking at oil blending. I think it is extremely important, mainly because there is a lot more job creation opportunities while trying to bring down inflation. It's a win-win solution that we're trying to look at, and I think this is why I say stocks like Zambia Sugar, when you start getting announcements like that, that's where you start to see stocks like Zambia Sugar a little bit more differently. Why? Simply because that means that their molasses will now be in demand and therefore their revenues are scheduled to go up. So the more the government pushes towards this blending story and the more it actually actualizes and activates it, God and Denny, where Denny should be mixing 80%, 80 to 90% product with ethanol, locally produced ethanol. The leader of that will be Zambia Sugar from their molasses production, which doesn't have to change a lot of their production capacity. Therefore, you actually see that it's higher margins because they're diversifying into their needs. So these companies who are diversifying their growth, they actually are the ones you also want to try and start buying into, especially if you're picking stock. So that's a key indicator that you want to try and look at. Now, the rest of the commodities market, aside from oil, we're seeing still downwards trends. We're seeing downwards trends we saw downwards trends in copper, which is down 1.4% on Friday. We also saw downwards trends in oil, which was in gold, which was upwards trends in oil, which gold, which was up 0.29%, and then Kwacha up 3.8%, up 9.34% year to date. And if you're in the digital currency space, your cryptos are getting smashed right now. Because they started quite well and now they're losing up momentum. Bitcoin was up 0.33%, but up 40%, 40.3% year to date. It was up 48% year to date at one point. So 8% is gone, people. Gone. 8% of your Bitcoin wealth is gone from this year. And then we also seen that Ethereum is down to 35% year to date, down 1.6%. And it is down from 46% year to date. So these two are losing juice. So this is why I always say keep your portfolios diversified, people. Keep your portfolios diversified. Don't always rush into trying to change things. Right. We do have a question here from one of our listeners. This is Mubita C. Sorry, let me just get this right. Please do not assassinate me. C. Quibere Jr., who is asking, what are the factors that you think are affecting the performance of the Kwacha against foreign currencies? Have the higher time frame objectives? What are the higher time frame objectives should be met? Right now, probably the main thing that's affecting the Kwacha is it's the seasonal effects that happened from the previous. It's the seasonal effects that were happening from the FISP purchases. Remember that we had agricultural purchases that were being done, and that was at high levels of fertilizer prices while we had fuel prices going up. So here's what you need to understand. When the oil price goes up, the amount of dollars that we need to buy oil goes up. Therefore, the dollar demand for oil goes up. The dollar demand goes up. And therefore, the Kwacha gets weaker. So it's the higher prices of the things that we need to import being fuel. Now, there are three things that we import a lot of in this country. This is why I've always talked about things like industrial hemp as a solution to Zambia. But there are three things that we import a lot of. And that's what I call the three Fs: fuel, fabric, and fertilizer. These are your three Fs. And if I add now pharmaceuticals, which is an F by proxy, PHF, but it's fuel, fabric, fertilizer, now pharmaceuticals, which are actually leading to the majority of a lot of the import, the exchange rate pressure that's sitting on our economy, and also the imported inflation that's actually coming into our economy. So we have to pay attention to what's happening in that regard, because that is a huge stress factor to our currency. While simultaneously, there's also worries about our debt. Our debt does not seem to be getting resolved. And then you're seeing all this geopolitical tension between America and China. Janet Yellen says this to China. China says this back. This one says speed up. This one says mind your business. There's all sorts of things being thrown at each other. And as a result, we might actually be slowing down in terms of our debt negotiation. One of the biggest problems I keep citing when it comes to Zambian debt negotiation is the Chimerica rift. China, America, who are no longer one integrated supply chain, but are now becoming regional adversaries who will sit on G20 together and will basically control a lot of the global narrative. They are the biggest threat to where Zambia's economic well-being is coming from. So I want to talk about quickly, Vernon, I want to introduce a thought on something called deglobalization. So this was a video done on a Bloomberg interview called The Next Big Risk. Yeah. And I want to talk about three things that actually affect where deglobalization affects Zambia. But I first want to play this clip, and this is the manager from what's it called? Bridgewater Capital, the CIO for Bridgewater Capital, who was being interviewed about risks coming in from the world no longer acting as one global supply chain. And you see these drifts of the major parties, these major players in the world now shifting away. And I'm going to try and bring this home as to what three key risks. I want everyone to pay attention. There are three key risks that are going to manifest in Zambia should we start to see the pace of deglobalization occur. So
Can you
let's
give
pay
a
attention to
sense
this.
of the scope of that? What does deeper mean? What does more frequent mean?
When you have a recession that the central bank can just solve quickly, because they'll go and they'll ease aggressively in the first sight of a downturn, right? You get a world where every time you have something go wrong in the economy, we get used to the fact that it just gets solved within a few months, even when it's really, really bad. And so these are very non-painful recessions in a very core way, because the most important firepower in the world, the central bank, and then fiscal policymakers could step in and try to make them not painful and go away very quickly. And we're moving into a spot where there are actual trade-offs. The central banks can do that if they want, but they will live with much higher inflation than they think is prudent to tolerate. So they're less likely to. And that means if you're in a recession, for the first time in decades, you'll be in a recession that might be hard to get out of. You might be kind of stuck in. And the stagflation years where that occurred are so far behind most of our memories. I think that these risks are exacerbated by how fast the pace of deglobalization is going to be and how problematic geopolitical tensions end up being. So if you look at what globalization had done, you had decades where the fact that the world came closer and closer together was a very powerful deflationary force. You were constantly taking goods and services that were being produced and move them to the cheapest possible place. And it made the whole world cheaper constantly, brought more and more labor online. And that was one of these big deflationary winds in the back that allowed central banks to keep coming in and easing when things were tough. Now, we know that the world can't re-globalize again, so that deflationary force is behind us, but you can decide how fast are you going to deglobalize. Are you going to literally go and try to tear apart all of those forces that put the world together in these years? And we don't know yet to what extent that'll happen. And that'll determine just how inflationary it is. And the biggest wild card here, of course, is how difficult the relationship gets with China, because China is so deeply embedded in supply chains that there's a big difference between having to kind of modestly cut them out or just have some double dues versus actually decoupling from China. That could be a very inflationary event that exacerbates this whole environment very significantly.
Okay, so this was actually a key conversation that was being had. As I said, this was Bridgewater. This was the Bridgewater CIO who was actually talking about what the world is going to look like going forward, and this is a key risk I want you to look at. So there are three key risks or three material changes to how Zambia is going to actually operate in this world. So she was talking about deglobalization. So let me talk about what that is first. So after World War II, the world seemed to globalize. So you saw supply chains going global. You saw America, who had very high labor costs because of unions, now start to go out into the world and try and see if they could produce in other countries. You saw that when we saw the end of colonization, people said, okay, since we can't just go into countries and take them over, we're actually going to have to just connect with their supply chains now and have these global supply chains, set up factories in their countries, because we can't just own the country and make it a colony anymore. We actually have to go and operate in their country. And the simple thing about globalization was it's similar to colonization. It was the pursuit of cheap labor. That is literally it. It was the pursuit of cheap labor to try and make production as profitable as possible, because in these developed countries, what tends to happen is that when they develop, inequality starts to pitch up. Labor unions start to get very strong, and those labor unions start to demand higher wages. These companies say, okay, you want higher wages? How about you go and stand in the unemployment line? And then they leave and go and start producing in other countries. They produce sneakers and all sorts of other things. And then people in developed countries start to recognize, oh, wow, life can actually be tough when factories leave. Even President Biden spoke to this. He said, a lot of the American middle class was hollowed out. He actually pointed out to this. He said a lot of the American middle class has been hollowed out by factories that went abroad. Ironically, he was busy calling President Trump a xenophobe for saying that, but he actually seems to now agree with the fact that the world, it's ironic how this all works out. but he now actually is standing on the point where he's saying, look, maybe, just maybe, Donald was right in that regard. So one of the things you start to see is that the world is starting to consider regionalization. This is happening around the world. China is now trading with Russia, trading with Japan. There's a lot of activity happening at a regional level. You're seeing America, who had that NAFTA, who took away NAFTA and created the USMCA, which is the North American, I think there was another new North American treaty which came where they united America, Canada, and Mexico together. Where it actually said, United States, Mexico, and Canada agreement, which came together and started to create more of a trade bloc. You're seeing South America talking about this as well, where President of Argentina and President of Brazil have come together to try and consider working on a single currency so that they can start to work together with the Caribbean. South America and the Caribbean can start trading together, working together, flowing together, and building an economy together, because they've actually seen the importance of it. And you're trying to see, obviously, a revitalization of the EU to try and strengthen its position thanks to a rogue Russia. So what's happening is that regional blocs are forming. Okay, regional trade blocs are starting to form. Obviously, Africa always gets left behind. We talk about Africa free trade, go for meetings, but whether anything gets done, that's another story. But what we've actually seen is even the administration is trying to cut as many bilateral trade deals with Africa. So here's the first thing that we're going to have to pay attention to when we're looking at the risks of deglobalization. The first one she points at is that deflation, a low inflation global environment, is not going to be as prevalent as we thought. It used to be that whenever the world got to it, whenever inflation started to pick up, remember that production will just move to an even cheaper country. Production will just move to an even cheaper country again. So if producing sneakers in America became too expensive, you go and produce them in Japan. In producing them in Japan, and this is the story of Nike, if you read their book, they produced their sneakers in Japan. When that got too expensive because of labor unions and a strong Japanese yen, they shifted it to Taiwan and Vietnam. To Taiwan. When that got too expensive, they shifted to Vietnam. When that got too expensive, they shifted again. They're looking to shift it again. So globalization always allows products to stay small, to stay cheap, and profits to stay wide, because it just can shift production to the cheapest zones. Okay, that is one of the main drivers of globalization, to constantly shift production to the cheapest zones of your global economy, to keep products as cheap as possible and profit margins as wide. Now, even though when recessions were taking place in the biggest parts of the global economy, what often would happen is that those big central banks would step in and juice the economy with money. They would just flood it with money. And because globalization and digitization of commerce were happening, prices could constantly stay low. Now, here's the problem. It appears that with the global supply chains have now started to retract, people are trading closer to each other, therefore exposed to more labor unions and higher labor prices, just like what's happening in America. Wage inflation was transmitting into actual inflation. You're also seeing it now around the world where wages are feeding in. And two, when your central banks now flood the economy with cash, that is more sensitive. The economy is responding. It's actually responding by hiring bond prices, expecting inflation. There's actual inflationary pressure. And because you've had a pandemic that has made people now scared of trying to use global supply chains, and they've realized the importance of domestic supply chains, therefore, whenever your central bank pumps money into your economy, you can't rely on China to keep things cheap anymore, because they've got their own issues and they can't supply to you, and you need to supply yourself globally, and you need to work with your own labor forces. So therefore, when money gets flooded, inflation gets created. So what you're seeing is central banks who are going to be a bit more sensitive, meaning deeper and longer and more prolonged recession. Geosynchronous, continuous economic growth that we depended on to constantly grow the economy and to do global trade with all these developed countries is no longer what we're going to see. We're going to see starts and stops in trade and growth. So therefore, depending on the global economy for growth is going to be a risk. So it's going to manifest in Zambia that our dependency on exports to the Western, or let me say the northern part of the world, because there's no more east-west. That's Cold War thinking. You've got to stop that mentality, people. That's how us people in Africa get tricked into being part of fights that have no issue with us. The actual issue is the rich north versus the poor south. That is what is happening in the world, okay? The rich northern world versus the poor south. Stop the east-west. I hear people I see people on Facebook, the west, as if the east are not equally as economically abusive. Okay, they're all economically abusive because the Northerners are abusing the Southerners. That's what's happening in the world. Okay, so we in the poor South have to fix ourselves as a global economy. Now we have to recognize that the rich North are no longer going to be able to transmit their growth into our economy, and depending on them totally will be a hassle. So we really have to look to regional trade to also do that. If we want to survive well, we need to strike trade deals with our fellow poor people who are in the South and start to actually build our nations on good trade lines. Vusi Tambukwaya actually said once, he said, the funny thing is in Africa, our middle class is actually quite big. We have 300 million people in the middle class in Africa, but they're separated by borders and trade restrictions and tariffs and import costs. So we can't trade with each other as an African middle class because we've gone and demarcated it, while the rest of the world, in China, their 500 million people in their middle class are trading with each other because there's no borders between the Chinese provinces. The American middle class are trading with each other because there's no borders restricting trade between the states. So, and the European middle class are trading with each other because of the EU. So you have to understand that if Africa wants to do that, we have to be able to leverage our 300 million people who are in the middle class, who earn and who are able to live off anywhere from $10 to $100 a day. That is the statistical definition of the middle class that the Africa Development Bank has estimated and utilized, that there are 300 million Africans who live anywhere from $10 to $100 a day. That is the definition of middle class person. Okay, so that is what we have to start looking at in terms of being able to trade. So that's risk number one. Risk number two is that inflation from imported goods will be more prevalent. So dependence on imported goods will lead to continuously imported inflation. So we will also have inflation risk coming through our borders should we continue to work in a world that is deglobalizing and seems to be deglobalizing at a fast rate because of this whole Russia-Ukraine conflict. Now, debt and finance is also a big thing. Deglobalization has created tension between America and China, the Chimerica rift I keep talking about, which has created a problem in our debt negotiation. In the short term, it's a risk because it's a risk to the debt position of the country and the resolution that's needed for debt. In the long term, it's an opportunity because Zambia can play America and China against each other, and also basically the east and west of the northern part of the global economy. We can play them against each other for maximum benefit as a country. Okay, where one invests, the other will seek to invest. Where one enters, the other will seek to enter. So they'll both now seek to try and help. Let me give you a simple example. China is looking to get copper out of Zambia, like many other resources like cobalt, to feed into its EV sector. America sees that and says, Zambia, we can help you. How about instead of extracting the copper, we come in there and help you set up a capacity to start developing your copper into EV battery parts and your cobalt into EV battery parts so that you can export battery parts to us and enrich your people. You see what happens when you play China and America against each other industrially. It actually reflects for the betterment of the nation because now we're getting competing support, rather than just getting overhauled by one global leviathan of a supply chain that squeezes the life out of a poor country. So this is an opportunity in the long run. So the three things that are going to come from deglobalization is, one, we are going to see that economic growth from global economic growth coming into our country will slow down because, and you're seeing it even in China. Economic growth is no longer sitting at 8%. It's now sitting at 4%. Zambia sits somewhere between about 2% lower than China. So we're probably going to be pegged at about 2.93% economic growth if we cannot decouple from China totally and start to look at trading more with our partners. And this is what agricultural trade is also doing to us. It's giving us the opportunity to trade more with our Africa partners, so as we invest in it more. And manufacturing is starting to kick in a bit more. So relying on global growth to stimulate Zambia growth will no longer be as strong as an argument. Expecting global inflation to stay very low and only having to contend with domestic inflationary forces, that's out the question. Imported inflation is now a real and live risk that can come through our borders. And three, the opportunity, the short-term risk of the Chimerica rift in our debt negotiation, but the long-term risk, the long-term opportunity of the Chimerica rift in our trade and investment negotiation. That is going to play out for the benefit of Zambia. So if you're investing, you want to try and play this and expect that inflation is not as low as we're expecting in the global economy. Growth may not be as great. So if you're seeing inflation and growth starting to have a little bit of concern, that's a bond portfolio play, just for a little bit longer. But you can only push your bond portfolio as long as you're also getting the other risk. I will actually put out there, when you're saying that central banks can no longer stimulate your economies anymore, those major economies anymore, that also means that they can't just pump a lot of excess cash, which is what the bankers and the traders will utilize to come into countries like Zambia and buy our bonds. So if central banks are a bit more sensitive about pumping cash in because they're thinking inflation might pick up, that means that the risk of offshore investors coming in to drive down the yields of bonds very easily may not be as prevalent as we thought. So if that deglobalization continues to happen, offshore purchases of bonds will be a little bit more moderated than was before. So these are some major concerns. But on our bond market, I always tell you that right now, a lot is skewing towards keeping the portfolio growing until we start to see interest rates coming down. And a lot of the signs are not showing towards interest rate coming down, including the risks of deglobalization. If you have any more questions, people, feel free. We are always available to answer some of these questions. Now, one of the things I wanted to talk about today, Vernon, and to everyone here, I wanted to talk about health and wealth, because this is an important conversation that we don't seem to be having, mainly not because I'm some health junkie and some health nut. In fact, the word health junkie seems very wrong and weird, but not because I'm some sort of health nut, but mainly because I understand how important this is for wealth purposes. A lot of people who are planning out their wealth don't seem to be dealing with health and wealth as the question. So I want to just quickly give out some quick views on this situation of health and wealth. The first thing I want to tell people is, if anyone remembers, I always talk about it. Unfortunately, I went and there's a little bit of a boo-boo there, but if you look very carefully, they are five. They're the high five investment goals, and the first one is harvest, not harvest. Harvest, health, higher education, home ownership, and huge purchases. Okay, so the second one there, and this is an order. I call this your order of investment. You want to make sure you sorted out your harvest, which is your retirement planning, health, which means your current healthcare financing and your healthcare financing in the future, and your health, because health is going to be your biggest cost and your biggest concern. And the higher education of your children becomes your biggest risk of liquidating your pension. Home ownership is something you want to secure because you don't want to go into retirement relying on people for housing. And huge purchases are things you want to manage that you desire to do once you've sorted out the top four. So we're going to talk today about health, and the reason I've just been banging on this point of health. So this is a survey, Vernon, that was done by Fidelity in their Millionaire Outlook 2019, and they asked the question: what is the biggest concern of the biggest concern of the wealthy is health. So as you can see, they asked what stressed millionaires are most concerned about health and life stresses. So the question that was asked is, what percentage of people who are millionaires who consider their life stressful? Okay, so they are.
Okay, we seem to have lost Mutwai there due to connectivity, issues and whatnot. But hopefully, we should be able to get him back just to finish and wrap up this session in time. Of course, he's not really with us though, but of course, we hope he's just here to finish up on the high fives, of wealth. Pretty much just to see that, of course, we're able to conclude the session in that regard. But of course, remember that we actually are live on social media in case you're just listening in on radio. That is, of course, on Facebook, Twitter, as well as Instagram. Equally, online on the website. That's www.moneyfmzambia.com. And if you have the Money FM app on your phone, of course, even better. But of course, just get us live on this conversation. Of course, if you missed the conversation today, you can still join in and enjoy a whole session of it on our social media platform, that is Facebook, Twitter, and Instagram. All you have got to do is, of course, click on the search. That will be, of course, Money FM, and of course, just by doing so, you'd have actually gotten through to our social websites, and be able to get yourself, check in conversation all the way. The full package, of course, of everything that actually has been tackled today here on Money FM. So we're getting into, of course, the next segment lined up still on Money FM, and of course, I hope you've had yourself, of course, a great time and a very informative time. And of course, you'll be locked on tomorrow, same time, of course, same place for Behind the Markets with Mtwale. Once again, thank you so much for listening, and
Okay, sorry about that. It appears we all just had a throwout session, unfortunately, there. So we will be just continuing with our conversation on health and wealth. To everyone who's still here with us, apologies for that brief interlude where unfortunately we got lost in the middle of that. But in terms of health and wealth, as we said, and some said this, one of the things that we have seen is that the biggest concern of the millionaire class of Zambia, not of Zambia, of the global community, not Zambia, sorry about that. The biggest concern of the millionaire community is their health. Okay, the number one concern is paying for healthcare. And because the costs of healthcare become enormously high the older people get. So the biggest thing that's actually stressing the life of people who consider themselves who are millionaires metrically, but consider their lives still stressful, is healthcare and health requirements. So that is something that we all want to pay attention to in terms of that. And in fact, later on, we're starting to see that even here, and for anybody who's still with us, please shout us a comment there. You can also see that the top 5 concerns of millionaires in general is health. And you can look at the questions that they keep saying there. Top 5 concerns of millionaires is 1, my weight, my health, my family's health, my social life, and paying for healthcare. So you can see a lot of it is related. So when people have all the money in the world, they are still deadly concerned about their health. And if you're looking at the top 5 concerns of millionaires of tomorrow, when asked the same question to investors with under $1 million in investable assets who are actually trying to gain wealth, they're also saying the same thing. My weight, my family's health, my social life, and paying for healthcare. So you can see that the number one concern here is health. Okay, so this is what I'm trying to tell you. And the connection between health and wealth is that even when you acquire wealth, health is still a concern. So not taking your health seriously while you're in the acquisition of health by either working laborious hours, refusing to sleep, putting yourself under mental strain without actually trying to figure out what to actually do can actually be stressful to you. And unfortunately can actually be detrimental to your wealth journey as well. Now, when you look at some of the stresses of millionaires, and we're going to try and bring this home towards Zambian data, you're seeing that 86% of less stressed millionaires were confident about their health, while 50% of millionaires do feel confident about of stressed millionaires. So you can see the difference. The people who feel happy are also feeling very healthy. Okay. And if you look at the health stresses, it says that less stressed millionaires are likely to manage their disabilities for themselves or their loved ones, while stressed millionaires are 2 times more likely to have a physical disability than their less stressed counterparts. And when they do not personally have disabilities, stressed millionaires are more likely to have to live in a household with somebody who's doing that as well. So you can see that it's also not management of that. You can show that fewer less stressed millionaires have experienced serious health issues, while 35% of stressed millionaires have experienced serious health issues. And you're also seeing that less stressed millionaires are more likely to turn to a professional for help when dealing with significant health issues. When less stressed millionaires do that stressed millionaires do that in a less likely fashion. So the affordability of seeing a health professional experiencing health issues. Now, I want to bring this home to Zambia. So let's take a quick look at health data. And I've looked at causes of death data. Again, I'm bringing this back up for everybody because this is from the Institute of Health Metrics and Evaluation of the University of Washington, who have said that hypertension is one of the fastest growing causes of death, up 60% in the last decade, followed by stroke. Okay, so it's hypertension, in other words, BP and stroke are your two fastest growing methods of death. In fact, the communicable diseases that we are used to, your malarias, your diuretic diseases, your HIV, are declining in their impact. The ones that are growing fast are the lifestyle, food-based and workout-based illnesses. Cirrhosis is growing 34%. And I'm going to talk about that just now. Heart disease growing 20%. So your fastest growing illnesses are coming from the things that actually come towards our lifestyle decisions. And these are also very costly illnesses. I also want you to remember that when you're treating these other things, okay, neonatal disorder, these are things that are treated once. Okay, when you're trying to treat respiratory infection, you're treating this once. Some of it can be prolonged. TB, yes, that's a lifestyle one. Malaria is treated once. But hypertension, you're on drugs for a long time, and those are costly. Cirrhosis, you're on drugs for a long time. That's costly. Heart disease, heart medication, you start to live on heart medication. People who are actually dealing with strokes have to go through very expensive procedures. So nothing is worse than building up your wealth throughout your life, only to have your wealth taken by health sicknesses and having to give it to the medical institution. So you have to ask yourself, okay, what decisions are you making now to ensure that your health is not at risk in the future? So that's question number one I just wanted to deal with. This is statistics to show how tough it is, and especially men. Okay, men are the ones who are seriously the most at risk in terms of our behavior. I want you to look carefully at the alcohol consumption statistics of Zambia. Zambia consumes 180 million liters of pure alcohol, not alcoholic beverages with a percentage, the actual pure alcohol. We're consuming 188 million liters of pure alcohol. We're also seeing that in Zambia, we're consuming about 950 million liters of almost 1 billion liters of alcoholic beverages, of which 60% is beer, traditional beer, 36% is clear beer, and 4% is spirits and wines. 77% of every liter of alcohol consumed in Zambia is consumed by men. See, this is my concern. The men of this country are literally pummeling themselves with high levels of alcohol. 38% of men are drinkers, while 17% of women are drinkers. 23% of men are binge drinkers, meaning that they go through serious episodes of harsh alcohol abuse, while this only happens to about 4% of women. 21.9% of men of pure alcohol, men consume 21.9 liters of pure alcohol per man per year, including the non-drinkers. This is per capita male, and 8.3% of alcohol consumed by women, though men, yes, do have a tolerance. And one of the things I'm concerned about here is 86% of alcoholics in Zambia are men. So you can already see that the cirrhosis levels, the stroke levels, the hypertension levels are going to come a lot from male wealth. So men who are building wealth, if you're not taking care of your health and you're not looking into this, the last few years of your life are going to be more costly. And also to the women who are married to these men also have to start thinking very carefully. Because one of the things we've also studied very quickly, and we're just going to try and round this up, is that the life expectancy of women, the life expectancy gap between women and men is actually starting to increase. The previous one was World Health data. This is World Bank and Washington University data. We're now showing that the life expectancy gap, since we have managed to handle the HIV pandemic, because you can see that in 1990, the life expectancy gap between a man and a woman was 2.8 years. Okay, it was just under 3 years. You saw that dropped to 2 by 2005, and that's mainly because HIV was equally killing men and women. We got a handle on it, and we're now able to slow down the impact of HIV and AIDS-related deaths in this country. And what we've now started to see is that this is starting to pick up again. The previous peak used to be about 4 years as well. Now, if you're looking up, you're seeing that from 2005 onwards, the gap between the life expectancy of a man and a woman has gone from 2 years in 2005 to 5.4 years, which translates to about 7%. The average woman is living about 7% longer than the average man. And by 2050, we'll be looking at an 8% gap because male lifestyles are more dangerous. Men don't go to hospital. Men drink more. We're 75% of smokers with multiple sexual partners. Many risks in our lives are leading to our lives always being shorter. Also, the physical work that we do, we engage in bus driving, truck driving, all sorts of dangerous jobs as well to make a living. And we also involve ourselves in physical backbreaking labor, things like mining. You find this majority men, bricklayers, majority men, construction teams, majority men. So those physical jobs that are going to take a toll on a man who does not go to the hospital physically to go and check. So here's the thing we need to look at, and I'm looking at this even in percentages. You're seeing that the bottom was 4% longer. Women are living 9%. Sorry, that's the statistic. They're living 9% longer than men, and they're scheduled to live 11.4% longer than men. So here's what this means in conclusion. And we're sorry, we've had to obviously draw this out a little bit more. But here's what this means in conclusion, is that because of the health implications, one, take your health seriously, because in the future, it's going to be your number one cost. So what you don't want to do is build millions of kwacha, get to financial freedom, only to take all the spoils of your financial freedom and hand it to a doctor and his medical team and the pharmaceutical industry because you decided your 20s was the time to YOLO your health. Even though you worked hard for your wealth, you went and YOLO'd your health, and now you're not able to enjoy your wealth. You will not be able to enjoy your wealth with poor health. Okay, that is a reality. So take care of it. I will tell you this very, very quickly. I'm in a health group, which I've been actually trying to fix a lot. I'm trying to work on my health. And there's a group of 40 people in there. They're like 3 guys, okay? 37 women in there, and like 3 guys, so 4 guys, 36. But 90% of the group is women. So evidently, women are the ones taking care of their health. And then in 40 years' time, we're going to say, how come men are not living as long? I don't know, because in our 30s, we thought going to a bar was more important than lifting a barbell. Okay, so these are some of the things that we have to try and look at very carefully so that we can actually enjoy our health. The second thing I want to really stress in this point is that women have to take finance more seriously. The wider that gap gets, the more women have to contend with years of retirement alone. What we don't want is the lonely widow who's now living off, who has to survive off her kids and is now fragile, or the survive off the state, or has to go to social cash transfer just to live because there was no savings and taking care of finances before. Women must start learning financial literacy. It's not a might, it's must. The reason is you are going to live up to 80. Most likely, your average woman by the year 2050 is going to live up to 80 years old, while the average man is going to clock up to 70. So with retirement at 65, the average man, 60 to 65, the average man can stretch his retirement to late and live only 5 years after that and really only have to worry about getting up to 70. The average woman has to contend with turning 80. So you got 15 to 20 years of retirement to deal with. Well, this guy only has 10 years. Now, remember, the average woman will marry a man who's 5 years older than her. So already this guy's got a 5-year gap on you. He's going to die 10 years earlier than you would live. So you got a 15-year loneliness period that you've got to try and contend with, where you have got no income coming in from that man, and you are probably dependent on the finance. So you got to ask questions like life insurance. You got to make sure that your pensions are resolved. You've got to manage these things very well, because you are actually going to experience a longer life alive, and therefore even your post-retirement years, you are more exposed to the elements than a man. A man is most likely going to die 5 to 10 years after his retirement, while a woman has to contend with over 20 years of post-retirement life. So what is your post-retirement strategy? So that's exposure to the elements. That's serious issues. So you have to think longer term. You have to start earlier. You have to start saving at higher rates. And that's the good thing. And you have to start making sure that there's many policies to protect your final years, because your years are longer. And you are likely, like I said, to be 15 years a widow in that regard. So I just wanted to put that health data out there. So that one, let's start taking care of our health. Even guys, if you want to try and live long and be helpful to your family, you may want to start doing that as well. Okay. And 2, women have to really start considering that with that life expectancy gap going wider and wider, you also need to start considering that you need to start looking after, you need to start taking some financial decisions into your own hands. I'm not saying go behind your husband's back, but you need to start taking some financial decisions into your own hands, because you are likely going to outlive your husband, who's already 5 years older than him, by 10 years. So you got 15 years to contend with on your own. And you don't want to be now that helpless, lonely widow who's now stuck, maybe when you were hardworking back then. So just some things to consider right now. So to everyone, that is a conversation we're having. We're going to be going back to the wealth matrix, which we had launched last week, and we're going to be going through each of those points this week. Please tune in tomorrow. Have a wonderful and blessed day. God bless to everyone. Peace out.